They pushed silver up to 80, and then they yanked the rug so fast it felt like gravity changed. One weekend the chart looked unstoppable. The next, it dropped like a stone, bounced like a spring, and dropped again. That wasn't normal volatility. That was the market testing nerves, flushing weak hands, and daring us to hit sell. I'm not here to calm you down. I'm here to tell you exactly what this moment is. A decision point. Not for the price. For you. Because when a trade becomes emotional, most people stop thinking in probabilities and start thinking in pain. I'm your host, and this is our room. No suits, no slogans, just clean logic, clean risk, and the truth as we can measure it. And if you're new here, welcome. This is where we think. Here's the core conflict. Silver just proved it can sprint. It hit the level everyone talks about, and then it snapped back hard enough to make people question the entire move. And now the question isn't, can silver go higher? The question is, do we have the stomach to stay with a fast horse while it tries to throw us off? Because silver is the fast horse. Gold moves like a battleship. Silver moves like a speedboat in a storm. Same ocean, same tide, totally different ride. First takeaway, this isn't a tidy, polite bull market. This is a market that punishes impatience and rewards conviction. If you want smooth, you picked the wrong metal. Now, watch this. When silver tagged 80, some people said, that's it, sell. Others said, that's nothing, it's going to 120, maybe 200. Both groups are doing the same thing in different costumes. They're trying to control uncertainty by pretending certainty exists. We don't do that. We separate facts from interpretation. Fact, silver ran hard, hit a major level, and then violently mean reverted. Fact, the move scared people who bought late and tempted people who bought early. Interpretation, the market is building a pattern, not ending a story. If you want to understand why a pattern matters, think of a coiled spring. Price expands, then compresses. When the range tightens, the spring stores energy. That energy doesn't tell you direction, it tells you intensity. When it releases, it's not a gentle walk, it's a shove. So what do we do while it coils? We don't pray, we don't guess, we watch the signposts. Signpost 1 is gold, because gold doesn't follow silver, silver follows gold. Gold is the engine, silver is the turbo. And gold right now is not being bid because people are bored. It's being bid because the world is tense, the kind of tense that doesn't show up in a CPI print, the kind of tense that shows up in reserve strategy and geopolitical posture, blunt version. Gold is not just an investment. Gold is a strategic tool. In conflict, in distrust, in fractured trade, countries want something that doesn't need a promise from someone else. That's gold. It's portable sovereignty. So when we see gold strengthen, we don't just see inflation. We see stress rising, and governments preparing for uncertainty like it's a season, not an accident. Now ask yourself this. If gold has more runway, does silver politely sit still? Or does silver, being the fast horse, try to outrun it? That's why a lot of us are not selling silver yet. But we're also not acting like cowboys. We're managing the emotional trap that comes with a triple bagger. Because if you bought in the mid-20s and silver's in the 70s, you're sitting on a win most people only talk about. That's where greed sneaks in wearing the mask of discipline. It whispers, hold for one more huge move, don't leave money on the table. And that's where the market kills people. Not with losses, with regret, with the torture of watching unrealized profit evaporate. Second takeaway, having a big profit is not the same as having a plan. Profit without a plan turns into a hostage situation. The cleanest psychological test is brutal, and it works. Imagine you woke up today and your broker accidentally liquidated your silver position at the current price. Would you buy it back right now? If the answer is no, then holding is hypocrisy. You're holding out of inertia, not conviction. If the answer is yes, then you're not trapped. You're choosing. That one question exposes who is investing and who is just hoping. Now, let's talk about what the upside numbers actually mean. People throw around targets like they're ordering coffee, 100, 120, 200, say them out loud and they feel like fantasy. But we don't judge numbers by vibe, we judge them by structure. Silver is a small market compared to gold. Gold is a giant reservoir. Silver is a smaller tank. It doesn't take much new demand to move the water level. That's why silver can feel calm for months and then explode in weeks. It's not magic. It's a thin float being pushed by thick money. And here's where the comparison hits. All the silver in the world can start looking like one megap stock. That's insane when you say it out loud. A metal that's been money for thousands of years priced like a single tech name. That's the kind of mismatch that creates violent repricing when sentiment flips. But we also have to be honest about supply. There's silver in the world, and then there's silver that actually hits the market. A lot of metal is locked away in forms that don't move quickly. Old flatir, antique sets, household hoards, industrial scraps. It exists, but it's not liquid like a futures contract. Third takeaway, float matters more than totals. A large stock doesn't save you if it's trapped in closets, museums, or long-term hands. Now, a lot of people will ask, is it too late to buy? Here's the rude truth that saves money. If you have to ask, the answer is usually no, because buying any volatile asset without your own internal reason is how you become exit liquidity for someone else. But that doesn't mean nobody should buy. It means the buyer must have a thesis, risk limits, and the ability to be wrong without going broke. This is educational. We manage risk. So if you're considering an entry, the question isn't, is silver going to 100? The question is, if silver drops $10 tomorrow, do I still behave like an adult? If not, you're not buying. You're gambling. Now, let's widen the lens. Why are metals moving at all? Because the macro machine is shifting into a new gear, and it's loud. We have two forces that like to pretend they're separate, but they're married. Geopolitics and industrial policy. On one side, rising tension between major powers. That alone puts a bid under gold. On the other side, a new spending era. Call it reshoring, reindustrialization, infrastructure, defense, AI build-out, pick your label. The point is the same. Huge capital will be deployed, and a lot of it will be financed the old-fashioned way by expanding balance sheets. That doesn't automatically mean hyperinflation. It means persistent pressure, the kind that keeps real assets in play, the kind that makes hard assets matter. Again, if money is created and poured into productive capacity, factories, grids, data centers, it can be less instantly inflationary than money sprayed into pure consumption. But less instantly inflationary is not neutral. It still changes the map. So we should expect an environment where metals and energy inputs get repriced, not because of fear alone, because of demand, which brings us to the metal nobody wants to talk about until it's too late. Copper. Clears throat and snorts. Copper is the wiring of the modern world. Data centers, power lines, transformers, motors, robots, everything that moves. Electrons wants copper. And the AI build-out is an electron-eating monster. If we're serious about a world filled with chips and automation, copper becomes the bottleneck you can't negotiate with. You can't innovate your way around basic conductivity at scale. So, while everyone argues about whether AI is a bubble, the ground truth is simpler. AI requires physical infrastructure. Physical infrastructure requires metal. Metal markets don't care about your opinion, they care about shortages. Now, someone will inevitably say, but AI is a bubble. The stock market is going to crash. Listen, people have predicted the end of the world every year since the first chart was drawn. If you live your investing life waiting for the perfect crash, you miss entire decades of compounding. Crashes happen. But the bigger mistake is being permanently afraid of them. We treat markets like weather, we prepare, we diversify, we keep optionality. And in this moment, the AI story isn't a cute buzzword, it's a productivity shock. It's the kind of shift that changes GDP trajectories and forces nations to compete in computing power the way they once competed in oil. The competition becomes strategic. Strategic competition pulls on resources. Resources pull on prices. Prices pull on metals. Do you see how the loop closes? Now, let's bring it back to silver and the exact decision in front of us. What does a rational person do when price is whipping around after a vertical move? They do three things. First, they define what would prove them wrong. If gold rolls over and loses its bid, silver's turbo loses fuel. If financial conditions tighten hard, metals can get punched. We watch those. Second, they scale their behavior to their risk tolerance. You don't have to sell all or buy all. The all or nothing mindset is how the market turns adults into toddlers. Third, they remember that tops are processes, not single candles. Most blow-offs don't end with one clean reversal in a straight line down. They thrash, they fake, they tempt you back in, they shake you out again. So, yes, some people try to wait for the high, then sell on the way down, accepting that 90% of the move is still a win. That's not my psychology, but it's a real approach if you can handle it. The point is not the method. The point is knowing your method before the market forces one on you. Fourth takeaway, the market punishes people who improvise under stress. Now, let me ask you something, and I want you to actually answer in the comments because this tells us where our community is positioned. When silver hit 80, did you feel excitement or did you feel fear? Second question, if silver tags 100, are you selling a piece, holding everything, or adding? Drop your answer below. I read them, and the pattern in the responses tells us more than the headlines do. Now, there's another landmine hidden in the original transcript. Marketing noise, dealer specials, phone numbers, brand drops. We're stripping all of that out because it's not analysis, it's filler. Our job is to extract the signal. The mindset was I see upside, I see even more upside, but I also see the edge of a logic eventually. That's healthy. It admits there's an upside case while admitting the story can become irrational later. So, how do we translate that into a clean framework? Here's how I would say it. I can map a path to 100, I can map a path to 120. I can even imagine a world where 200 happens. But beyond that, The narrative starts depending on mania, not math. That's not bearish, that's disciplined. Because the goal isn't to be right at the top. The goal is to get paid and live to trade another cycle. Now, we need to talk about oil for a minute because it's the sleeping elephant. Oil can look cheap compared to the inflation we've already lived through. And if the world is about to consume more energy, AI, manufacturing, electrification, energy inputs matter. But oil is political. Producers have budgets. They have incentives to pump. Sometimes price stays lower longer than it should. That's why timing oil is harder than spotting the undervaluation. Still, we keep it on the board because when oil wakes up, it doesn't stretch. It sprints. So if you're thinking diversification, don't just diversify tickers. Diversify drivers. Some assets are driven by fear, some by growth, some by electricity, some by war, and silver sits at the intersection of multiple drivers. Monetary demand, industrial demand, risk-off flows, risk on speculation. It's a hybrid. That's why it moves like a maniac. If you wanted a boring hedge, you'd only buy gold. If you wanted a levered bet on gold, you'd consider silver. But leverage cuts both ways, so we don't marry it blindly. Here's the practical approach for 2026 from where we're standing right now. We stay diversified. We avoid FOMO buys at the top of a spike. We don't take random tips from strangers. We build positions we can actually hold through drawdowns. We treat this like farming, not like roulette. Farming means you plant in seasons, you accept storms, you don't dig up the crop every morning to see if it's growing. Casino means you need constant dopamine, and the market will happily take your rent for that addiction. And here's the trap. People confuse information with skill. They watch 10 interviews, memorize 10 targets, and think they earned certainty. Markets don't pay you for opinions. Markets pay you for process. Process means position sizing, patience, and the humility to cut when your premise breaks. If you can't explain why you own something in one sentence, you don't own it. You're renting it. And when price whips, renters panic first. We're not renting. We're measuring. We're choosing entries with rules, exits with dignity, sizing that lets us sleep. That's how we stay in the game. So if you're holding silver right now, here's the real question. Are you holding because you understand the thesis or because selling would admit you got lucky? Luck is fine, but pride is expensive. Now we need to talk about the thing most people hate, the possibility that we're wrong. If we're wrong, where will it show first? It won't show in a commentator's mood. It will show in gold losing its strategic bid. It will show in tightening conditions. It will show in a shift from we need hard assets to we need cash now. So we keep our eyes on the inputs, not the noise. And if you want to keep tracking this with us, do one thing right now, subscribe. Short, simple. Because this cycle will move fast, and you don't want to be the person finding the story after the price already moved. If you got value from this, hit like, not for vanity, because it pushes this kind of no-fluff analysis into more feeds and it helps our community grow. So where does that leave us? It leaves us in a market that just revealed its personality. Silver will spike, silver will smash, silver will shake you, and silver will reward the people who planned ahead. I'm not selling silver yet, not because I'm greedy, because the engine gold still looks like it has runway, because the macro shift, real assets, still looks like it's beginning, not ending, and because when the fast horse runs, you don't jump off just because the saddle squeaks. But we're not blind either. We'll watch the signposts. We'll manage risk. And when the story turns from logic to mania, we'll be ready to act. Stay sharp, stay measured, and keep your head while the chart tries to steal.